Peter Orszag is here. He's the CEO of Financial Advisory at Lazard. He's also the former director of the Office of Management and Budget under President Obama. And Peter, it's an interesting morning. A lot of things we're trying to dig through. Can you offer any help or any insight to kind of point us in the right direction? What do you take out of this SVB situation?
Well, I actually think it is potentially dangerous. So a couple of points. First, let's just look at the direct impact. The most likely direct impact is just on the tech community itself, which has been battered by valuation. But a lot of these companies have relied on this particular bank for liquidity. They'll have to go elsewhere and expect some dislocation from that. But the big question, as you were just discussing, is what more than that? And I point to just two things. One is the core issue here, Becky, as you had pointed out, is there are a bunch of assets that have not really been marked to market. And that is a broader phenomenon where when interest rates go up, these bonds that are held and available for sale or held to maturity, the value of them go down. They're not immediately recorded as such, depending on which category in particular. But that is a broader phenomenon because that is not specific to Silicon Valley Bank. And so that's one question. And the other question just involves confidence, a variety of different, the underpinnings of the financial system fundamentally depends on confidence. Waking up to seeing problems at a well-known bank in a particular community doesn't help from that perspective.
All right, let me ask you this. The idea of not marking things to market properly and not being forced to do that by accounting standards. I was wondering this morning, and I'm a little reluctant to say this on air, but is hold to maturity, HTM, the new CDO? Obviously, the banks are better capitalized all the way across the board, but especially the big banks at this point. But that what you're saying kind of keys me back to that question. How big of a deal is this?
Well, how big of a deal it is depends a little bit on how long interest rates remain high, because that's what's driving this disjuncture between, or the change in the valuation of those bonds. And that brings us back to the inflation dynamic. But this is one reason, by the way, why I've been saying for a while that I wish the Fed would tilt towards pausing and seeing how things play out. I think it's better to do that than to keep raising and then be forced into reversing your position quickly as you try to clean up a mess that results from it.
Peter, can help explain to the audience, and I think we were trying, maybe not as artfully as I'd like personally, to the audience, what actually happened at Silicon Valley Bank, because it appears to me that they made a strategic decision, if you will, because of some of these bonds that they were holding at what was a lower interest rate, and said to themselves, I'm going to rip this Band-Aid off. I'm not going to do this right now. We're going to sell this. We'll take the loss, and we'll go to a floating rate to try to capture a higher number. That unto itself has been taken by the market as something existential, and I'm not sure whether you think it should be or shouldn't be.
Well, Andrew, I think we don't know all the facts yet, so I want to be a little bit cautious here. But the fact of the matter is right now what's happening is they have a combination of problems. One is a lot of their depositors are now pulling funds. That's, right. I think, pretty clear. And they also have this problem with regard to two categories of bonds that they had previously held as capital in terms of their value. So what the instigating shock was, which is what you're sort of getting at, I think, still remains a little unclear to me, but the situation that they face right now is, a situation that a bank just doesn't want to find itself in because of this concern. It comes back to that confidence. Once people start, this is the classic run on a bank. I mean, once people start pulling funds, no one wants to be the last person standing.
Peter, we have a vast structure in this country designed to create a series of buffers before there's ever a run. If I'm not mistaken, the bonds you're talking about are essentially treasuries or other liquid instruments, right? They're not sitting there holding high-yield, high-tech bonds as part of their capital. So aren't there a number of facilities available to them at the Federal Reserve where they can take these bonds, put them to the Fed, get back the cash, and then use that to pay their depositors? What am I missing there?
Well, there were a variety of different bonds held, not just treasuries. So that's the first point. I think the second point, and this is a broader question, by the way, we are going to have, we are, I think over the next few days, going to see a process in which SVB will now try to either raise capital or potentially be sold, or there's likely to be there will at least be discussion of whether the federal government needs to step in, even beyond the facilities that currently exist. So this is coming back to my first point. This is definitely a topic to watch very carefully because of its potential, not its direct impact, but more because of its potential to raise concerns about what's happening in the portfolio of other banks and how are they valuing their assets, and is there a broader confidence problem?